Dear students, welcome you all to session 28, chapter Mutual Funds, Financial Management, 6th semester BCom of Mangalore University. In this session, let us understand the methodology of investment in mutual funds or how to make investment in mutual funds. There are different schemes floated by different mutual fund companies. So every month different mutual funds comes up with new schemes. So it is on the investor to decide whether to invest in the existing scheme or a new fund offering of a mutual fund. So when a new scheme is offered by a mutual fund, it is actually advertised in the newspapers. The investor has to fill up the application form to subscribe to this scheme. The mutual fund schemes will have various agents and distributors, and they provide the services like application form distribution, providing information about the scheme as well as the investment advice. Banks as well as post offices also help in this distribution of mutual fund schemes to the investors. So the mutual investor who is desirous of investing in mutual funds can approach these respective offices and they can collect the information. So along with the application, they will get the offer document, or it is also known as the key information memorandum, wherein the information regarding the main features of the scheme, the risk factors involved in investment in mutual fund scheme, the initial issue expenses, the recurring expenses to be charged, the entry load as well as exit load, the sponsors track record, the qualification as well as the work experience of the persons like the fund managers, the performance of other schemes launched by the same mutual funds. All these informations will be given in the key information memorandum. The investor has to read this key information memorandum and then he has to decide whether he wants to invest in the mutual fund schemes or not. So investment in mutual fund is not free from risk. So risk is involved, that is all the investment in mutual funds and securities are subject to market risk, and the net asset value of the schemes may go up or down depending upon the factors and forces affecting the securities market. So what happens is sometimes the investors may be able to get high returns, sometimes it may be a low return or it may be a negative return. So investor has to be careful while investing the amount in the mutual funds. So in case of investment, the investment can be made in a lump sum or it can be made in a systematic investment plan, which is actually a method of investing a fixed sum of money every month over a period of time regardless of the mutual fund's unit price. So two ways of investment is available. One is investing a lump sum amount, that is, now for example you are buying mutual funds for 50,000 rupees or 1 lakh rupees or 10,000 rupees. One lump sum is invested and the mutual fund units are purchased. The other scheme is wherein you invest or you invest every month. For example, every month you pay 1,000 rupees and buy the mutual fund, that is mutual funds, that is called as the systematic investment plan or SIP, which is actually a method of investing fixed sum of money every month. Now under this plan what happens is a fixed sum of money is invested in equity as well as equity oriented mutual fund scheme, and it avoids the problem of market timing, and usually it gives a higher return if the investor has long term investment horizon, and through the power of compounding this plan usually does well in the long run. So the features are, it's a way to invest in mutual funds regularly. It's like a recurring deposit scheme. The idea is to set apart a sum every month or a quarter. Same amount of money is invested in the mutual funds. It actually helps in saving regularly. A saving habit is formed, as well as it helps in building an investment corpus for the investor. And another important aspect of the systematic investment plan is it has brought the mutual funds within the reach of an average person, as it enables them to start the investment with rupees 500. So when you start earning your income, you will have to open a public provident fund, a recurring deposit fund, as well as a systematic investment plan of a mutual fund. You can start with just rupees 500 per month, so that over a long period of time it will turn out to be a huge investment. Thank you.